In February 2025, Federal Reserve Chair Jerome Powell sat in front of the Senate Banking Committee and said something that stopped a lot of people cold. He said, and I'm quoting directly, "If you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage." He wasn't talking about a far-off hypothetical. He was talking about what's already happening right now in places like coastal Florida. Banks and insurance companies are pulling out of high-risk coastal areas. Thousands of home closings have been frozen, and the 30-year fixed mortgage, the loan that most Americans depend on to buy a home, is quietly becoming harder and harder to get in Florida's coastal communities. This is the story of how that happened, what the numbers actually say, and what it means for anyone who owns, rents, or is thinking about buying near the Florida coast. Here's the core thing to understand. Banks don't just hand you a mortgage and wish you luck. They require you to carry homeowners insurance, and in flood-prone areas, flood insurance on top of that. The reason is simple. If your home gets wiped out by a hurricane, the bank still needs to get paid back. Insurance is what guarantees that. So when insurance disappears, the mortgage disappears with it. And that's exactly what's been happening in Florida. According to insurance.com data from 2025, the average annual homeowner's insurance premium in Florida is now $7,136 for just $300,000 in dwelling coverage. That's not a typo. The national average is less than half that. Florida's rates are the highest in the country, driven by hurricane exposure, rising rebuilding costs, and the fact that out of the 10 costliest hurricanes in U.S. history, 7 have hit Florida. But it gets worse. In some coastal South Florida neighborhoods, premiums were reportedly approaching $11,000 per year as of 2023, and they've climbed since. And for a lot of homeowners, the issue isn't just the cost, it's that they can't find coverage at all. Multiple private insurers have pulled out of Florida entirely. The state-created insurer of last resort, Citizens Property Insurance, saw its policy count surge past 1.4 million, meaning over 1 million Floridians couldn't get private insurance and had nowhere else to turn. The situation got so messy that one homeowner in a coastal county told Inside Climate News she was getting cancellation letters so frequently she ran for city commission over it. She's now a vice mayor. When private insurance dries up, mortgage lenders are stuck. They legally cannot close on a property in a FEMA flood zone without proof of active flood insurance. And in late 2025, when Congress failed to reauthorize the National Flood Insurance Program, the federal program that covers flood risk, thousands of Florida closings were put on hold overnight. Agents were shocked. Buyers walked away. Deals that had been months in the making collapsed in a matter of days. Now, here's where the 30-year mortgage specifically becomes the issue. A 30-year mortgage is a bet. The bank is betting that your home will still be worth something and insurable 30 years from now. That's the entire foundation of the deal. But researchers at the floods.org research network concluded something that more and more lenders are being forced to reckon with. Many of Florida's coastal homes will not outlast their 30-year mortgages without serious damage or expensive adaptation. Let that sink in. The bank lends you money for 30 years, but the property they're securing that loan against might not survive those 30 years in its current state. According to McKinsey research, about 25,000 homes in Florida already flood more than 50 times per year. That's almost once a week. By 2030, that number could grow to 40,000 properties, representing roughly $15 billion in value. By 2050, it could reach 100,000 properties worth $50 billion. A separate 2025 report from the First Street Foundation projects $1.47 trillion in net property value losses over the next 30 years, driven by insurance pressures and shifting buyer demand nationwide, with Florida coastal markets leading that exposure. Large banks, which tend to be the most conservative lenders, have started quietly tightening standards for coastal properties. Research from the New York Federal Reserve found that big banks are perhaps the most conservative when it comes to lending in high flood risk areas outside FEMA's official flood maps. Some lenders are charging higher rates, some are shortening terms, others are quietly declining applications for the riskiest zip codes. And the buyers who do close, many are skipping the mortgage entirely. According to data from early 2026, 33% of all Florida transactions are now all cash deals. In Miami-Dade, that number jumps to 67% for luxury properties over $1 million. Cash buyers don't need insurance to qualify, so they bypass the whole problem. That means coastal Florida real estate is quietly becoming a cash-only market in the highest risk zones. If you need a mortgage, the doors are closing faster than most people realize. Real quick, if you're finding this breakdown useful, hit subscribe. We cover the Florida real estate market every week. The actual numbers, what's shifting, and what it means for real people. Hit subscribe so you don't miss it. The lending pullback isn't theoretical anymore. You can see it in the price data. According to Zillow, the median home value in Florida dropped 5.4% year over year as of November 2025, one of only a handful of states in the entire country where prices are falling while the national index is still rising. This home price index has posted 13 consecutive months of annual declines as of late 2025. Florida now leads the entire nation in foreclosure filings. 0.44% of homes received a filing in 2025, with 4,962 filings in January 2026 alone, according to Adam data. Condo markets are in even rougher shape. Post-Surfside legislation, passed after the 2021 collapse of a beachfront condo building in Surfside that killed 98 people, now requires structural inspections for all buildings 3 stories or taller that are 30 or more years old. The result has been a wave of special assessments that have blindsided owners. At one North Miami building called the Cricket Club, owners were hit with assessments of up to $134,000 per unit. At Mediterranean Village in Aventura, the assessment reached $400,000 per unit for some owners. Monthly HOA fees in Miami-Dade high-rises jumped nearly $500 per month in 2025, with insurance alone averaging $377 a month in some buildings. Half of the top 10 U.S. metros with the most unsold condo inventory are in Florida right now, and 43% of condo sellers in Florida have had to reduce their asking price, compared to just 17% in 2021. Second home mortgage originations in Miami fell 32.2% year over year in 2024, the steepest decline of any major metro in the country. Investors who were buying coastal Florida condos as short-term rentals or second homes have largely backed off. The tone has shifted fast. So where does this leave homeowners, buyers, and investors right now? For people who already own coastal property in Florida, the biggest risk isn't the mortgage rate, it's the insurance cost eating into what they can afford every month. Jeremy Porter, head of climate research at the First Street Foundation, put it plainly. Homeowners who took out a mortgage 5, 10, or 15 years ago expected certain costs. That math has been flipped on them, and many are working 2 jobs just to stay in their homes. For buyers, the message is to look at the total cost of ownership, not just the price tag and the mortgage payment. In some coastal zip codes, insurance alone is adding $500 to $1,000 per month to what you thought you were paying. That changes the entire budget. For investors, the data's clear. Coastal condo markets are under severe pressure, and the exit window is getting more crowded. The buyers who are still in these markets are largely cash-heavy, high-net-worth individuals who can absorb the carrying costs. Everyone else is being priced out. And for the broader market, the warning Jerome Powell delivered in February 2025 isn't a distant concern. Some regional lenders and community banks are already factoring climate and flood risk into their loan decisions in ways they weren't 5 years ago. The New York Fed's own research shows large banks are pulling back from the highest risk coastal zones. This isn't about one hurricane season. This is about the long-term math of lending money against property that is increasingly expensive to insure, harder to sell, and more exposed to physical risk. As of right now, 30-year mortgages are still available in most of Florida, but in the highest risk coastal zip codes, they're getting harder to get, more expensive, and for some properties, when insurance can't be found at all, impossible. Everyone watching this market is on edge, and this is only the beginning. That's why homeowners, renters, and investors across Florida are all paying close attention right now. The market is shifting faster than the headlines are catching up to. If you want to stay ahead of it, subscribe and drop a comment below on what you're seeing in your market. We read everyone.